Something big is happening in Ontario's real estate market, and almost nobody is talking about it honestly. Home prices are quietly shifting, inventory has exploded to levels that we haven't seen in years. Mortgage delinquencies, the number of people that are missing mortgage payments, are rising faster than anyone expected. And behind the scenes, developers, banks, and investors are making moves that tell a very different story than the everything is fine headlines that you see in the news. And here's the part that should make everybody pause. We are now officially in a market that behaved nothing like it did during the pandemic, not even close. If you bought a home, if you're thinking of buying, if your mortgage is renewing in 2025 or 2026, or if you're an investor trying to make sense of all of this chaos, this is the most important update that you'll hear all year. Because the decisions that you make over the next 12 months are going to impact you financially for the next decade. So today I'm breaking down everything that you need to know about mortgages, real estates in Ontario, using real data, real trends, and real strategies. So let's get into it. Across Ontario, benchmark prices are down 5% compared to last year. In the GTA, detached homes are down more than 7%, now sitting around that $1.36 million mark. Condos, especially downtown, have been on a 2-year slide. Investors who bought back at the peak pricing are now facing negative cash flow, higher rates, and slower rent growth. But the real story isn't the prices, it's the inventory. Inventory across Ontario is now at the highest level that we've seen in years. In the GTA, active listings are up 40% year over year. In the suburbs, inventory is up 60, 70, even 80% in some areas. This isn't normal, this isn't seasonal, this isn't temporary, but this is a sign of a market undergoing a major structural shift. Buyers suddenly have choice. Buyers have leverage. Buyers have time, something that hasn't been true for over a decade. But that's not all. For the first time in more than a decade, Ontario's mortgage delinquency rate is now higher than the national average. Toronto alone saw a 60% increase in missed payments this year, the highest since 2012. The actual delinquency rate is still low by international standards, but the trend matters. It tells that the higher rates and renewal pressure are finally starting to hit household budgets. And then we have the commercial side. Commercial investments in the GTA are down 13% year over year. Office buildings are struggling. Industrial is stable. Retail is surprisingly still strong. All of this points to the same conclusion. Ontario's real estate market is no longer being driven by hype, emotion, or FOMO. It's being driven by fundamentals. So in the next part, we're going to talk about what's really driving this shift. Now that we've set the stage, let's look at the deeper forces shaping the market. Because when you actually understand these factors, you understand exactly where the market is headed next. Number one, home prices are repricing, not crashing. Across Ontario, home prices are down 5%. Detached homes down over 7%. Condos are on a long, steady slide. This isn't a collapse, it's a reprice. A correction from pandemic-era valuations were inflated by cheap borrowing, bidding wars, and emotional buying. Prices today are being driven by income, borrowing cost, and buyer philosophy, not fear or frenzy. This is what a normalizing market looks like. Number two, inventory is surging, and this is the most important indicator. Inventory is up across the board. GTA is up 40%. In some suburbs, we're seeing 60, even 80% increases in inventory. This is massive. High supply means less competition, softer prices, longer days on market, more negotiating power, and more leverage for buyers. Inventory is the clearest indicator that Ontario's moving into a high supply environment for the first time in years. Number three, mortgage delinquencies are rising, a pressure point to watch. Ontario's delinquency rate is now at 0.23% above the national 0.22%. Toronto saw a 60% spike in missed payments. This tells us that monthly payments are harder to manage. Household budgets are stretched. Renewals are hitting hard, and financial pressure is increasing. This isn't panic territory, but it's a sign of stress. It's the first crack that we've seen in almost a decade. Number four, sales are soft, and buyers are extremely cautious. Even with more inventory, sales aren't surging. Buyers are careful, strategic, they're patient, and much less emotional than what we saw in 2021 and 2022. Gone are the days of 24-hour sales and 15 offer bidding wars. This is a data-driven buyer pool. Number 5, the rental market is telling a split story. Vacancy rates are slightly higher in major cities, but rents are still increasing year over year. Affordable units are extremely competitive. Higher end units sitting longer. Mid-range rentals getting squeezed by demand. This split tells us affordability challenges remain and renters are staying renters longer. Number 6 is commercial real estate confirms the slowdown. GTA commercial investments are down 13%. Office is weak, retail is strong, and industrial is stable. Commercial trends often predict a broader economic behavior, and right now they're signaling cautious adaptation and recalibration. So what does this all mean? Ontario's real estate is not in a free-for-all. Ontario is not crashing, but Ontario is going through some major recalibrations. A slow, fundamentals-driven, data-heavy real estate cycle. And this brings us to the most important part: what should you do next? If you're a buyer, for the first time in years, you have leverage, you have choice, and you have negotiating power. This is a market where patience pays. You can negotiate price, conditions, repairs, upgrades, and even closing credits. The key is preparation, having your pre-approval, your budget, and your timeline locked in. If you're a seller, this is a skills market, not a hype market. To sell successfully today, you need smart pricing, professional staging, strong marketing, and realistically understanding of the buyer's behavior. Homes that are priced right still sell quickly. Homes that chase yesterday's prices, they just simply sit. If you're an investor, this is the moment where real investors rise and speculators disappear. Cash flow matters. Rental demand matters. Location matters. Value add opportunities matter. The easy money era is gone, but fundamental-based investing is strong again. If you're renewing in 2025 or 2026, this is a big one. Most people in Ontario don't know this, but the bank's first renewal offer is always the most expensive one. You have options: switch lenders, extend amortizations, blend and extend, explore fixed versus variable, consolidate debt strategically. Renewal shock is real, but with the right planning, it doesn't have to derail your finances. The bottom line is Ontario's housing market is entering a new era, not of chaos or collapse, but of clarity. A market where buyers can breathe, sellers need strategy, investors need discipline, and homeowners need renewal planning. If you want help with any of this, whether you're buying, renewing, refinancing, or building a plan, you can book a call with me with the link below in the description, or simply visit meetjustin.ca. I'm Justin Chausse of the Chausse Mortgage Group, and if you found this video helpful, please like and subscribe so that we can continue to make more videos like this for people like you. Thanks for watching, and I'll see you in the next update.